Good morning and welcome to The Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Wednesday, August 5th, and we have a packed show. The S&P 500 is building on a fresh record close, AI earnings are dominating the tape, and a critical ADP jobs report drops this morning. Let's get straight into it. Lizzie, the S&P just closed at a record 7,736, up nearly 13% year-to-date, with Ed Yardeni calling his 8,250 year-end target conservative. What's actually driving this rally right now?
Morning, Robert. It's really two forces converging at once. You've got Strait of Hormuz optimism pulling oil down more than 10% on the week, which eases inflation fears and takes some pressure off the Fed. And simultaneously, a blowout earnings season headlined by AI names with blended S&P 500 earnings growth, running at 47.4% year over year, the highest since the post-COVID rebound in 2021. Prediction markets on Kalshi are now pricing a 72.8% probability of the index hitting 8,000 or higher by year-end. And with 86% of reporting companies beating EPS estimates this season, the fundamental support is genuinely solid.
Palantir is the headline earnings story, up nearly 30% after 93% revenue growth, with CEO Alex Karp calling AI demand otherworldly. Is this a one-stock moment, or does it signal something broader about where institutional money is flowing?
It's broader than just Palantir. When you see ARM Holdings up over 17%, and Marvell jumping nearly 13% in the same session, that tells you institutional capital is rotating aggressively into software and silicon names that can demonstrate real AI monetization, not just CapEx promises. The Palantir print essentially validated the thesis that enterprise AI spending is translating into revenue, and that's lifting the entire ecosystem from semiconductors to data infrastructure plays.
SpaceX beat on revenue but still dropped 7 to 11% on CapEx of $18.36 billion in Q2 alone, and deeply negative free cash flow. Is this the market finally pushing back on the cost of the AI build-out?
That's exactly the right read, and it marks a significant shift in market psychology. For most of this year, investors were rewarding AI capital expenditure as a signal of ambition. Now they're penalising it as a signal of capital destruction, and SpaceX is the clearest example of that turn. The key question for the broader market is whether this scrutiny spreads to the hyperscalers when the next round of earnings comes through.
AMD fell despite record quarterly revenue of $11.5 billion, and Musk announcing SpaceX is going exclusively with NVIDIA's Blackwell servers didn't help. How much of that drop is NVIDIA taking the crown versus the broader CapEx anxiety?
It's both, but the Musk announcement was a meaningful catalyst. When SpaceX publicly commits exclusively to NVIDIA's Blackwell architecture, that's a direct market share signal that AMD's data center ambitions face a real ceiling in the most high-profile AI deployments. AMD's data center revenue hit a record $6.7 billion, which is genuinely strong, but the stock is trading on narrative as much as numbers right now, and NVIDIA owns that AI narrative almost entirely.
Caterpillar jumped as much as 9% on a 92% surge in order backlogs tied to AI data center infrastructure demand. Is CAT quietly becoming a stealth AI trade?
It really is, and it's one of the more notable sector rotations this earnings season. When you think about what it takes to build a data center at scale, power systems, heavy construction equipment, materials handling, Caterpillar sits right at the intersection of all of it. The company is up over 45% year to date, and with order backlogs surging like that, this is not a one-quarter story.
Steve, the ADP private payrolls report drops this morning with the forecast sitting at just 70,000, well below last month's 98,000 and the prior month's 122,000. What does a number that's soft tell us about labour market direction, and how closely should traders be watching this print?
Traders should watch it closely today because ADP has been consistently printing below forecast for 2 consecutive months. June came in at 98,000 against a 113,000 expectation, and May was 122,000 against a higher bar. So the trend is clearly decelerating, and a print at or below 70,000 this morning would reinforce that the labor market is softening in a meaningful way. Coming just 2 days before Friday's official NFP number, today's ADP sets the directional tone for rate expectations heading into the weekend, and that context matters because the ISM manufacturing PMI, surging to 55.6 on Monday, its highest since May 2022 and well above the 54 forecast, actually creates a conflicting signal, since strong factory activity argues against aggressive Fed easing, while soft payrolls argue the opposite. And that tension is keeping the 10-year Treasury yield pinned near 4.6%, with a September rate hike still very much a live conversation.
With Friday's NFP forecast at 80,000 for July, up from last month's 57,000 miss, And Jolt's already sliding to 736 million yesterday. What's the realistic range for Friday's print, and what does it mean for the Fed's next move?
Given the current leading indicators, the realistic range is probably 50,000 to 90,000, with the labor market showing enough softness that a print below 70,000 would genuinely rattle Fed expectations and push the September rate hike narrative off the table. Jolts came in at 736 million yesterday against a 7.4 million forecast and down from 7.54 million the prior month, signaling that employer demand for workers continues to cool, and initial jobless claims last week printed at 197,000, slightly better than the 200,000 consensus, though tomorrow's claims number is forecast to tick up to 202,000, which would add another softening data point ahead of Friday's headline print. If ADP today and NFP Friday both come in at the weak end of the range, the September hike case weakens considerably, and that becomes a material catalyst for both bond and equity markets.
Lizzie, flipping to crypto, Bitcoin is holding near $64,000 but is still down roughly 30% since the Iran conflict began in late February. Bitfinex says on-chain data shows supply redistribution rather than capitulation. Does the chart actually support a bullish read here?
The on-chain argument is reasonable. 54.6% of circulating supply still in profit suggests holders aren't panicking. But the technical picture is more cautious. Bitcoin has been consolidating in the $60,000 to $70,000 range, and Arthur Hayes' thesis of a possible dip toward $50,000 can't be dismissed, given that Strategy just sold over 1,600 BTC at a loss, and the Cold Card wallet hack has added roughly $89 million in sentiment damage on top of that. Spot Bitcoin ETFs are still seeing inflows, over $170 million recently, with iShares leading. So institutional demand is present, but the path of least resistance looks sideways rather than a clean breakout at this stage.
Hut 8 and Bitdeer are pivoting hard toward AI infrastructure. Bitdeer just landed a $4.7 billion and 16-year Norway data center deal, and Hut 8 has $7.5 billion in project financing lined up. B. Riley is upgrading the whole mining to AI space. Is this a genuine structural trade, or are we getting ahead of the fundamentals?
The Bitdeer deal is genuinely significant. $4.7 billion is in contracted revenue over 16 years at roughly 90% operating margins, backed by JP Morgan credit support, with an optional extension that could take total value to $8 billion. And when NVDA rises 2% and Dell gains over 7% on the same announcement, traditional tech capital is clearly following that rotation in real time. Hut 8 is a messier story. They missed Q2 revenue estimates at $74.9 million versus the $80 million expected. But $7.5 billion in project-level financing and 949 megawatts of contracted AI data center capacity gives you real structural visibility into 2027 and beyond. So B. Riley's upgrades on Hut 8, Core Scientific, TerraWolf, and CleanSpark are grounded in improving fundamentals rather than pure narrative.
Arthur Hayes is calling the AI spending boom a Lehman not Apple moment, and the Situational Awareness hedge fund just collapsed and sold its book to Citadel in a fire sale. Does that change the risk calculus for AI-adjacent crypto names, and where does that leave ETH and Sol?
It raises a meaningful caution flag without necessarily closing the trade. But you have to respect what a hedge fund fire sale to Citadel signals about crowding in AI-leveraged positions. The smarter approach right now is to distinguish between names with real contracted revenue, like Bitdeer and Core Scientific, versus names repricing purely on AI narrative without hard cash flow visibility. And Hayes' warning is a useful reminder that the AI capital expenditure cycle has a credit dimension. Markets haven't fully stress-tested yet. ETH is holding near $1,160, and SOL is trading around $73, with the broader altcoin complex remaining range-bound and highly sensitive to any shift in risk appetite. Though it is worth noting that Intesa Sanpaolo's reported rotation out of Bitcoin ETF exposure and into BlackRock's staked Ethereum product suggests some institutional money is beginning to view ETH as the more defensible position in this environment.
That wraps up today's Morning Bell. This is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.